Hi, welcome back. The news of the moment, of course, is the Russian invasion of the Ukraine, and it's playing out in almost every aspect of our lives. It's playing out in the news, it's playing out in markets, it's playing out in economies, it might even be playing out at your job. Now, it might seem a little callous that I'm going to talk about markets and economies at a time when people are dying. But let's face it, I'm not a political expert and I have no solutions to this problem, and you're not on this site to listen to me talk about my views on humanitarian questions. So I'm going to focus on markets and economies and talk about how this war is playing out there and what might be the long-term consequences for all of us. Before I start, I think we need to lay the foundations here. Leading into this war, if you look at Russia and the Ukraine, they were countries that had small economic footprints. Now, let's face it, Russia is a military superpower, but its economic footprint doesn't match its military power. You can see that if you look at the GDPs of countries in 2020, Russia and Ukraine are a tiny slice of global GDP. Russia is about 2%, Ukraine is close to 0%. It's 0.19%. So by itself, you can say, what's the big deal? These two countries are such a small part of the global economy. That might be true. And notwithstanding the military power, you're saying, why should we care? Here's why you might want to care. These countries have much larger commodity footprints, especially Russia. I mean, here are 4 commodities where Russia has a significant share of the market in terms of how much they produce. In oil, Russia is the 2nd largest oil producer in the world. In coal, it's the 6th largest. In nickel, it's the 3rd largest. And in iron ore, it's the 5th largest. So while its economic footprint might be small, the footprint it has in terms of commodity production is much larger. Something to keep in mind when you start to see what happens when the hostilities begin. So when the hostilities began around February 23rd, the first place you saw the reaction was in bond markets. Why? Because lenders start to worry about, will I get paid? And we have markets now that track how people think about sovereign default, the sovereign CDS markets. For better or worse, they give you an instantaneous market reaction to what's going on. So if you look at the sovereign CDS spreads for Russia and the Ukraine around February 23rd, you see the spike. And we're talking about major spikes. Russia's CDS spread, which used to be around 200 basis points before this crisis, jumped to above 1,000 basis points. Ukraine's default spread, which used to be higher, around 600 basis points, jumped to levels that basically meant that the country was likely to default. Now, since then, those spreads have come down a little bit, but they reflect at least the market's instantaneous reaction to what was going on the ground. You say, what about ratings agencies? Ratings agencies are usually slow to react, but in this particular crisis, Moody's in particular has reacted particularly quickly. It's lowered Russia's rating 3 times over the course of 2 months, which is unprecedented if you think about ratings agencies. But Russia's rating now is essentially C. It's not just junk bond rating, it's low junk bond rating. So clearly people are worried about sovereign default risk in Russia and the Ukraine. Again, you might say, why does it matter to me if I'm not in these countries? Well, there are ripple effects. And you can see these ripple effects when you look at what's happened to sovereign default spreads around the world. I think the only part of the world where you've seen sovereign default spreads decrease between January 1st, 2022 and March 16th of 2022 was the Middle East. And there, the rising price of oil might be making default risk less likely, but in every other part of the world, sovereign default spreads have jumped. If you take Eastern Europe, not including Russia and the Ukraine, you see a jump of 51%. I mean, it doesn't make these countries risky yet. They started off as low risk, but they've become much riskier. So we're talking about Poland, Czechoslovakia. What used to be part of the old Soviet Union, you've seen a jump in spreads, perhaps because people are scared. Latin America has seen a jump in spreads by 19%. North America by 23%. In fact, every part of the world you see a jump, and essentially people are much wary about default now across the world by sovereigns than they used to be. Now, it's not just the sovereign default spreads that have gone up. Corporate default spreads have also gone up. These are corporate default spreads for US corporate bonds by ratings class. Now, on the graph, it's tough to see how much they've gone up because the rise is so gradual. But take a look. Let's take a triple B rating. On December 31st of 2021, at the start of this year, a triple B rated bond had a default spread of about 1.21%. By March 16th, that default spread had widened to 1.79%. If you take triple C and lower, 6.78% becomes 8.02%. Default risk is not just being perceived at the country level in Russia and the Ukraine, it's spreading into other countries, it's spreading into the corporate bond market. The price of risk in the bond market has gone up. Let's turn our attention to equities. Again, let's start local. If you look at the Ukrainian and Russian indices, neither country has a really good index that captures the country. But no matter what index you look at, there's been a collapse in value. You can see it in the Russian index. The drop in value is precipitous, as is the Ukrainian index. Incidentally, trading has been suspended for most of the last 3 weeks, so we don't even know what the actual current market values will be for most of these companies. Incidentally, if you focus in on some of the higher profile Russian companies, you can see this collapse happen in real time. Here, I'm focusing on 4 Russian companies, all of which are listed on the London or the New York Stock Exchange or the US stock exchanges, all of which are held by global investors. You have Sberbank, which is Russia's most dynamic bank in every aspect of Russian financial services. Severstal, which is probably Russia's biggest and most prolific, best known steel company. You got Lukoil, which is of course the Russian oil company. And you got Yandex, which is Russia's biggest technology company. Now, these companies, until a few months ago, were regarded as good investments by global investors. And once the hostilities began on February 23rd, you can see the stock prices collapse. In fact, since trading has been suspended for much of March, what we have here are prices through the end of February, and you can see the prices dropping by 80, 90, 95%. Sberbank is trading at close to zero. Now, you can read this in one of 2 ways. You can see this as markets saying these companies are going to cease to exist and your equity is going to be worth nothing. But I think that might be a misreading. I don't think these companies are going away. But that doesn't mean your equity will hold up, because it's entirely possible that one of the things that comes out of this crisis is that the Russian government steps in and essentially takes over your equity. So these companies might still be around, in fact, prospering a year or 5 years from now, but the market saying your share of its equity might not hold up. Now again, let's look at ripple effects. Here I've broken down the change in market cap by region. This is something I did during the COVID months, and I'm going back to it during this crisis. Obviously, the region that's most affected is Eastern Europe and Russia, with much of the drop happening in Russia, down 51%. But in every part of the world, except again the Middle East, you see market caps down. In fact, in the developed markets, United States, Europe, this is uncommon. The developed markets seem to be feeling the pain as much or more than emerging markets. In fact, Asia is holding up a lot better than the United States or Europe, reflecting the global ramifications of this crisis. If you break down by sector, again, no surprises. Energy is the only sector that's up. No surprise given how much oil prices have spiked, as we'll see in a few seconds. Consumer discretionary is down 19.33%. In fact, technology and consumer discretionary have been the 2 sectors most badly damaged. I also did take a look at subgroupings of companies. I'm again using a very simplistic proxy for mature versus growth companies by looking at price to book ratios. And you go from lowest to highest price to book ratios, you can see the damage has been highest in companies that trade at high price to book ratios, which is again a standard for growth. Mature companies are holding up their value much better than growth companies. Companies with less debt, and I'm measuring debt by looking at net debt, debt minus cash, as a scale to EBITDA. Companies with the least debt are seeing their value. Companies with the most debt, so this ratio is lowest. Companies with the most debt are seeing their market caps drop by more. So the more debt you have, the lower your net debt to EBITDA, the lower your net to EBITDA, the worse this crisis has impacted you. And in fact, everything that's happening in this crisis is what you see in a conventional crisis. Much as we'd like to think about COVID as setting the template, COVID was an unusual crisis where you often saw things you didn't expect to see in a crisis. This is a much more conventional crisis, hurting young companies, high debt companies, and you're seeing this play out in the market. Now, of course, the question then becomes, how does this play out in the metrics we use to look at markets? As many of you know, I'm very fond of computing implied equity risk premiums during crisis because it gives me a sense of what the market is expecting. So I computed the implied equity risk premium for the S&P 500 by day this year. Now, something to note. One is, if you look at the equity risk premium, started the year at 4.24%. By the start of February, it was already up to 4.56%. So leading into this crisis, markets were already starting to adjust. Equity risk premiums were creeping up. The expected return people were demanding on stocks was going up. The crisis did increase that acceleration in equity risk premiums. And by March 16, the equity risk premium was up to 4.79%. In fact, a few days before, the implied equity risk premium crossed 5% for the first time in a very long time. Market stocks are still priced to earn about 7%. So don't get me wrong. This is not making stocks go up the way they did in the 2008 crisis. But clearly, people are scared, and you're seeing this play out in higher prices for risk. Now, of course, in any crisis, you see the flight to safety. And initially, the two havens, historically, the 20th century havens benefited. The US dollar strengthened and T-bond rates decrease, which you see in terms of looking at T-bond. So initially, the drop in both. So you can see the drop in T-bond rates right after the crisis. Now, with T-bond rates, the drop did not last long. In fact, in the last 3 weeks, T-bond rates have started climbing again up to 2.19%. So that flight to T-bonds was very brief and passed quickly. And even with the dollar, the strengthening looks large because the way this graph is scaled, and incidentally, I don't scale it, Bloomberg does it. It's an increase of about 2 to 3%. So the flight to safety to traditional havens is not happening that much. You're saying, what about crisis assets? Well, gold kind of lives up to its name. It briefly crossed $2,000 after the hostilities began. It's dropped off since, but it's well above where it was before the crisis. It's trading at close to $2,000. So gold held up, as it has for thousands of years. Well, Bitcoin is, of course, millennial gold. It's been offered as a new collectible. Initially, there was a spike. I don't know whether this was because of Russian oligarchs pulling their money out of dollars and euros and putting this in. But again, the spike did not last. So we're going to have another test of Bitcoin as a collectible. It failed during COVID. Let's see how well it does during this crisis. So far, not much to show. Now, earlier we pointed to the footprint that Russia has, especially in the commodity markets, and even the Ukraine is a fairly large commodity producer. So early on, when this crisis started, the effects showed up in the commodity markets. You saw oil prices spike to close to $130 a barrel. Gas prices, nickel prices, iron ore prices, and coal prices, basically the commodities where Russia has the biggest footprint. Now, the question is this a temporary spike that will go away? Well, I guess part of the answer depends on how long the conflict lasts and what damage it does to the commodity production. But part of it also can be seen in the forward markets. Incidentally, as spot oil prices spiked, forward oil prices stayed around $80 to $90 a barrel, suggesting that people didn't expect the spike to last that long. But the spike is real, and it's here. Now, if you look at how this is playing out in markets, one of the fears markets had even before this crisis was about inflation. And guess what? This is not helping. Inflation expectations have gone up. In fact, I've used two proxies for inflation expectations. One is a traded instrument on expected inflation. You see the spike there after the crisis, so February 23rd and up. The second is the Fed's measure of inflation expectations, which is very simply the difference in the T-bond rate and the TIPS rate. On both measures, inflation is going up. Again, you can't blame the crisis for higher inflation. This was a problem coming in. It's just become worse because of the crisis. Now, as inflation expectations have come down, consumer confidence took a slide. In fact, it's down to a decade-long low. It didn't reach this low even during the COVID crisis. Clearly, consumers are scared. And again, this could very well pass by next month, but that's something to keep an eye on because that consumer confidence is going to clearly play out in how the economy does. Now, Bloomberg actually surveys services and economists on the likelihood of a recession in both the US and in the EU. The chance of a recession has gone up. not to sky high levels. It's gone from about, to about 20% in the US from about 15%, and to about 25% in the EU from about 17.5%. People are clearly much more worried. They're saying, what now? Clearly, when you look at the damage that's been done, you can't fix that if your portfolio is exposed. So if you own Lukoil, you're feeling the pain. But the question now is, what do we do now? So one of the things I decided to do was go back and revisit my valuation of the S&P 500. If you remember, on January 1st, 2022, I valued the index at about 43.20, and at that time it looked overvalued by about 11% because the index was trading at about 47.66. The index has come down to 44.31. In fact, it briefly was down to about 4,200, which was below my initial valuation. But I can't stick with my initial valuation because the world has changed under me. T-bond rate has spiked at a speed faster than I expected. It was 1.51% at the start of the year, up to 2.19%. So I revalued the index. Now, original valuation, I had targeted 2.5% over the next 5 years. I'm now pushing it up 3%, and I might be still undershooting. I did update the earnings numbers, and incidentally, so far at least, analysts don't seem to be predicting a blow to earnings from this crisis. Now, they might be blind to the damage, but I'm going to stay with that. And with those assessments, my new valuation of the index is about 4,200. So it's come down from 43.20, but it's now closer to where the index is. So again, file that away. The spreadsheet that I did this valuation is available for you. So if you don't agree with something that I've done, just go in and change it and see what your valuation of the index is. Now, as an investor, the question is, what do we do now? I could suggest that, if you're a knee-jerk contrarian, your default belief might be that markets overreact. And you're going to go in and buy every market that's been most damaged. I think that's a very dangerous strategy because knee-jerk contrarians sometimes catch falling knives. If on the other hand, you believe that you're a momentum investor and you believe that the information is not being fully incorporated, you're going to go with the big winners so far and expect them to keep going up. I'm not a market timer. I'm not a knee-jerk contrarian. I think it's too dangerous. I'm not a momentum investor again. I think it's too lazy. I think that what this particular crisis needs is a scalpel, not a bludgeon. So I'm going to suggest one of three ways in which you can play play the market or model your investments leading out of this crisis. One is you look at technology. It's clearly down significantly. It's true for old tech as well as new tech, and it's down about 20% since the start of the year. Well, there are some tech companies that clearly looked overvalued at the start of the year that look undervalued now. A few weeks ago, I valued the 6 stocks that comprise the FANGAM: Facebook, Amazon, Netflix, Google, Apple, and Microsoft. And I bought Facebook then, and I said Google and Amazon looked a little overvalued. I'm not ready to buy them yet. With this crisis, that changed. And I did buy Google and Amazon. They were at limit buys based on my valuation. Now, of course, the young tech has also been damaged. The Pelotons, the Zooms, the Ubers of the world. Now, I think that requires a joint bet on both the company and the economy staying strong, and I don't think I'm willing to make a double down on that bet. I do own some of these stocks from before, but I'm not adding to that exposure. So that's the first strategy, discounted tech. The second is, and this is particularly true if you believe that this crisis is going to stretch on and have tentacles, is safety first. You invest in companies with significant pricing power and stable, at least relatively speaking, revenues. Now, you can look at the traditional places, branded consumer products, food processing, pharmaceuticals, but I'd strongly suggest you look at big tech because they're some of the biggest and most powerful cash machines around. And finally, if you're daring enough, you could try the Russia play. Well, that might mean buying Sberbank and Severstal. But as I said, 2 notes of warning. One is that, these stocks might not start to get traded for a while. And second is, these companies might come back, but your equity might not, because a share in a Russian company is not a part ownership of the company. The protections you get as a shareholder are pretty slim. And you might find that out for yourself if you invest in these companies. Less risky route might be to buy companies that are exposed to Russia: Pepsi, McDonald's, Philip Morris in the US, quite a few European companies. Watch the stock price. If you feel the stock price if the stock price is overreacting, it might give you a chance to get in on those companies. Here's the bottom line, and it's a sobering thought. When you have a crisis like this one, you at least have to consider the possibility of a worst case. The worst case here is a nuclear winter, that there could be nuclear and chemical weapons used. I'm not sure there is any protection you can get as an investor from that. Your first reaction has to be survival. But here's what you need to factor in. Markets have to bring in that probability of this low likelihood high catastrophe scenario into the pricing. And luckily for us, these catastrophes very seldom unfold. So what I'm trying to say is, after most crises, when you look at markets, are going to come back. And the natural reaction you might have is, hey, markets overreacted. I should have bought low. You said this in March of 2020, in November of 2008. But what we're failing to factor in is in November of 2008, there was a very real chance that the global financial system could be laid low if 2 more investment banks collapsed. It didn't happen, luckily for us. In March of 2020, there was a very real chance that the global economy that had shut down would have real trouble waking up again. What I'm trying to say is, if this crisis passes, and I'm praying and hoping it does, and markets come back, don't take that as a rubber stamp that markets always overreact to crisis and just buy blindly when there's a crisis. No, I hope you found the session useful, and I hope that by the time we speak next, there's far less human damage, because I'd much rather be talking about stuff that is happier, more joyous than about war. Thank you very much for listening, and I hope to talk to you soon.